is there a point at which the US military machine gets called in to just say, hey, look, that's been such a great advantage for us. We really want to like stop the competition or curtail it?
Well, I think it depends how smart they are. And so it's funny because, we did that in the past. Basically, some have argued that some of our military inventions were based on, basically maintaining the system. But when you have a nuclear power like Russia selling oil outside of the dollar-based system, there's little you can do about that militarily. They've been doing sanctions and things like that, for kind of related reasons, not necessarily citing that reason. Just, basically, we're unlikely to do, say, kinetic military action against that sort of, situation. Now, if they are smart, they basically would realize that the way that it's currently structured is that the United States military is doing a really good job of making sure that China is able to access all the oil they want. And so basically, it's one of those things where the cost has gone up and up and over time, whereas who's benefiting the most from the system is actually shifted away from the United States. And so right now, it's basically we're paying for the system, but it's not necessarily benefiting us in the same way that it did decades ago.
Like I said, super fascinating. I would love to tug on that thread further. I'm going to have to reserve tugging on it the next time we have you on the program, but just fantastic and really fascinating insights, Lyn. Thanks. I want to pivot now to sort of why I started with the dollar here. Many of the people who are viewing this video, they are concerned about the future purchasing power of fiat currencies. And most of them are Americans, so I'm sure they care most about the dollar, but we do have people from all over the world watching, and they have concerns about their own home currencies. Do you share those concerns? And if so, where do you think capital is going to be better treated than just being held in the cash of those fiat currencies?
Yeah, so the answer to the first part is yes. I do think that fiat currencies are not very attractive in this current environment. Ray Dalio, for example, referred to cash as trash, and I think that's it's a colorful way of saying that basically you're getting little to no interest rates, in some cases negative interest rates, to hold cash, and yet the inflation rate is in most countries positive, in some cases strongly positive, and so you're not keeping up with the rise in prices. And so if you're holding cash in a bank, probably 5 years from now you're going to have notably less purchasing power, even if there's no major inflation spike or major kind of reset or something like that. Just the sheer kind of losing points every year is a big issue. And that's actually already been happening over the past decade, where most of the past decade you did not get positive real yields by holding either T-bills or cash in a bank. And it's kind of accelerating here in the 2020s. And so I do think that overall, fiat currencies are not a good store of value, especially in this current environment. And where capital is better treated, I think that it depends on what country you're in and what you're interested in investing in. But I think that there are a variety of equities, in the commodity space or in some of the value sectors that are pretty attractive at the current time. I think there are assets like precious metals or farmland that are attractive. I've been using Bitcoin as a diversifier. They're basically, there are pockets of value around the world, and every couple quarters, generally, you have one of these kind of open up. Either you have a correction or some sort of cyclical event happens, and it basically allows kind of an accumulation event to happen until that becomes more consensus, and then you kind of look for kind of what else got cheap.
So I want to dial through a couple asset classes quickly, if that's okay. I want to preface all this by saying there are a lot of people out there, and I'll put myself in the camp, that look at asset prices' response to the intervention by the world central banks, not just since the pandemic, but really since the great financial crisis, where at this point, many assets are at all-time record high levels of valuation. And the term "the everything bubble," has been put out there, which that almost every asset class is now in an asset price bubble. And so you mentioned there about every so often there's a correction, you can rotate into the group that's corrected and get in at some better prices. I think a lot of people right now kind of have the worry that, oh my God, almost everything is overpriced and in danger of a really painful correction here. So with that background, and I give that because if you think differently, feel free to opine on that. But let's move to equities, because I think there we can make a pretty strong case that there's a lot of equities that are at all-time level, not just prices, but valuation metrics, whether you're looking at PEs, price to sales, Buffett ratio, whatever. So I guess how concerned are you about those levels of valuation in equities right now? Are you concerned about money that's put into the market long these days at an undue risk of like a 50% type of market correction that folks like Jeremy Grantham are warning about? Or do you think that those fears may be overblown?
There is a foundation for those concerns. And so overall, my base case would probably look more like, after the late 60s when we had very high equity valuations and we entered a more inflationary period, you had a really choppy sideways market. It basically had a ton of volatility. You had significant drawdowns. You had poor returns. You had very poor inflation adjusted returns. And so overall, I'm kind of looking at that as kind of the lower end case for how this likely goes, where basically the way it's currently structured, I don't think you're going to have, like, say, a 1929 style crash, because that, in that environment, the dollar is pegged to gold. So basically what you're doing is you're pricing the S&P 500 or the Dow in gold, and that's going down significantly and staying down for a very long period of time. Whereas if you're pricing something in a denominator that itself is losing value, it's a little bit more fluid. It basically can soften some of those giant crashes. But overall, if you look at the S&P 500, by most metrics, we are either the most expensive we've been in terms of, say, the Buffett ratio, the market capitalization to GDP, whereas other metrics show that we're like the second most expensive we've ever been in terms of, say, the CAPE ratio. Basically, we're second to the dot-com bubble. And there's 5 to 10 indicators that you can look at, and most of them say number one or number two. And so that's obviously a really big challenge for the forward returns of stocks. Now, a complicating factor is the fact that bond yields are also super low. And so, for example, if you look at the dot-com bubble, the equity risk premium was very, very low, meaning that it was almost a no-brainer to buy treasuries instead that were yielding like 6% and had a positive real return compared to buying equities. The challenge in this environment is if you look at, say, the past century of data, stocks are still kind of in a place where they could do equal or better returns potentially over the next 10 years than 10-year treasuries. And so investors kind of have that challenge where, they're both bonds and stocks are very expensive in absolute terms. And because those are the major kind of liquid investment classes, a lot of people kind of looking at those two and say, well, I'd still rather own a significant chunk of equities. I think if you look under the hood, so if you look at, say, certain sectors that are not in favor, a lot of those are actually, either averagely priced or in some cases underpriced compared to their historical average. And so, the everything bubble is in many ways more of an interest rate bubble that then, caused a duration bubble. And so, long duration assets like growth stocks are at extremely high valuations because they're using an extremely low discount rate that might or may not persist. Whereas if you look at equities that, they basically have more of their cash flows in the near term, the next few years, like value stocks, like banks or energy companies or healthcare companies or pipeline companies, things like that. Those are actually in many cases either trading at valuations that are, in line with the past 30 years, or in some cases they're pretty cheap. And so you have some, like, for example, the energy sector that's been in like a 13-year bear market. And so I do think that there are pockets of value both in certain sectors and if you look at internationally, if you look at, say, certain Russian stocks, if you look at certain Japanese value equities that have global exposure, or if you look at, some of the things in Southeast Asia, for example, I do think there are pockets of value out there that someone can basically piece enough of those together to have a diversified portfolio that limits the probability of a, say, a 50% correction or other kind of, permanent loss of capital.